This is Duke University.
We're coming up to our next call. In fact, we might be slightly over. Katie, would you make your way down? Thanks. In the past year, how often have you personally, we'll skip that. Here's one of my favorites. There's a dummy answer here. Let's see how many people that list the dummy answer. 1% decrease in return. You see that? So straight away, I've got my A group and my B group. See the answers 16 and 5? What's the difference between the answers there? For every 1% decrease in return. Get it?
Yeah,
2%
you
is
can
the
say
dummy
decrease,
answer.
but you might as well.
No, but the 2% is the dummy answer. Because you might as well at least get 8%.
Yeah, that's what I'm saying.
Oh, you did? Okay. Should we make a call?
Are you going to do Skype?
Okay.
You said you wanted to do Skype first.
No, let's just do the talk. I don't want to. I'll just pull out this website. Did anyone? Okay, I'll look at who the immediate B's are later. Okay? Yeah. Please complete it if you haven't already completed. Is it fun? Is it helpful? Yeah? Gives us something to talk about. I could lecture here all day, but let's make it real.
So I guess my question to you there is why are you decreasing returns? If the assumption is you're factoring on all these things would actually increase your profitability because you're assessing risks to a better degree.
Sure.
Shouldn't profitability be higher now?
Sure.
Lower?
So
Should
it's-
you actually be? Yeah.
Sure, so the answer to that data point, if I'm working with clients, I'm working with their investment philosophy and process, is I'm trying to pick up the utility curve. That's what I'm trying to map. So we mapped it for, it's an institutional investment decision, up to 12 individuals. So you need to look for the group as a whole, what is it? ESG investment utility curve.
Okay.
Is it all good? Is it through the speaker?
Yeah.
We can't hear it through the speaker.
Well, then we're just putting you on the speaker. Let's see.
Welcome, are you there?
Hi there, guys.
Oh, it's from a long way back. We're just working on the audio level.
It might be your headset.
Can you guys hear me all right?
Yeah, that's better, that's better. We can hear you. Can you hear us? Can you hear me?
Excellent. I can hear you, Graham.
Excellent. This is coming to you from a little cable that someone laid under the ocean. Isn't that amazing?
But just careful, there are lions at the door. I just want to chase them away quickly.
All right. So, quick backstory to Malcolm is Malcolm went to law school like me. Wasn't as good, it was further away from Durban. But he is running money for a boutique investment manager. It's a large player in South Africa. It's kind of middle for global emerging markets. They are a regular sponsor of rugby, so a critical part of the investment infrastructure as a whole. They are sponsoring Tottenham Hotspur, so they've broadened out their experience. Malcolm, I've asked him to talk about two things. One is he's just launched a Pan-Africa fund and how he thinks about ESG factors in his Pan-Africa fund. And then also he's involved in responsible investment more broadly at Investec Asset Management, including looking at a global voting engagement platform. So across the shop, where it votes, they have this engagement strategy. So I've asked him to touch on those two things. So Malcolm, we have about 10 minutes of time with you. Thanks very much for making the time, and I know it's late back home. So you have 45 very interested MBA and graduate students ready to hear what you have to say. I have the website page up in front of them.
Great. Well, I think it's a good afternoon to everybody there, and good evening from not so sunny Cape Town anymore. It's about 9:45 in the evening here. Very excited to be chatting to you all, and I hope you can all hear me clearly. When Graham asked me if I would participate this evening, I said absolutely, and there were a number of reasons why I was excited to chat to an MBA class, because first and foremost, I myself am an investment professional without any investment training, and that may sound a little dangerous, a bit like an explosive expert who's never seen a bomb, but the reality was that I spent a lot of time thinking about sustainability in my undergraduate years as a geologist and a hydrologist, and eventually in my postgraduate years doing law and a master's degree in environmental law. And soon realized that in order to properly affect the responsible investment vision that was starting to emerge in the late 90s, we needed to move from fighting the battles in the courtrooms to controlling the capital, and that, through a series of fairly serendipitous events, led me to Investec Asset Management, and over a period of time to be doing what I'm doing today. So I look forward to sharing with you some of my insights. The two topics that Graham has asked me to touch on, firstly, the African or Pan-African space. To contextualize it, we manage a significant portion of assets of the South African economy, and we are the single biggest investor today in Africa outside of the DFIs, so the private sector investor in markets outside of traditional fixed asset investments, which many DFIs like the World Bank, the IFC, etc. are involved in. We have fairly extensive experience in Africa today. Environmental, social, and other sustainability issues are obviously an important component of what comes up all the time, although I think it's important to stress up front that it is not front and center to our investment processes within the Pan-Africa Fund, but increasingly in the funds that I run, and I have a sister fund to the Pan-Africa Fund, which is called the Africa Opportunities Fund. It is a core component and a core input into what I look at. The issues are complex. We're dealing with emerging economies which have somewhat less developed regulatory systems. We're dealing with countries where the income and poverty levels are significantly different to what you're probably used to in more developed economies. And as a result, one has to adopt a fairly pragmatic approach to sustainability issues. Core to the way that I operate is I look to combine a combination of what I call top-down sustainability thematic thinking with bottom-up fundamental valuations. And in the fundamental valuation component, I look to integrate some of the environmental and social insights that we gain from engaging and researching our companies in terms of helping us determine the possible valuation gap that the market might be missing. So from a top-down perspective, Africa presents a number of interesting sustainability thematics. Amongst those are obviously the issue around consumers and key issues around scarcity factors such as food issues and related services, whether it be around water as well as agricultural products. So we look for some investments in that sphere. We have to be relatively unconventional in terms of identifying these opportunities. We're not necessarily looking at a range of listed opportunities which have agriculture or water written on them, but have to look inside and under the hood of a lot of the companies we look to invest in. So that gives you a sense from the sustainability perspective, the insights that we're looking to gain in Ghana. I thought maybe to give to sort of give an example, and particularly given the low economy aspect for seminar that you're having today with Graham, I thought I would use an interesting company example. In South Africa, listed on the South African Stock Exchange, the JSE, is a sugar company called Illovo. Now, sugar companies, unlike in the US, where I think you probably, in most of your states, are used to sugar beet, although there may be some sugar cane grown down south. Sugar cane is a fairly prominent agricultural product in poorer African countries. And Illovo operates sugar milling and sugar growing operations across the continent. Its key operations are in South Africa, Malawi, Tanzania, Zambia, and Mozambique, with a number of exploratory opportunities in West Africa, North and West Africa, Mali being one in particular. Now, a traditional way of looking at a sugar company would be an agricultural product with no particular sustainability characteristics to it. However, if you shift your paradigm slightly, what a sugar company really is actually like an energy company. Firstly, they have a renewable resource, which is the sugar cane, and that renewable resource has a particularly important impact with respect to absorbing CO2 from the atmosphere. Sugarcane has been proven to be one of the more efficient converters of CO2 into its growing process and hence into energy. But more importantly, in the crushing process, what you have is a waste material called bagasse. The calorific value in the bagasse far exceeds the energy needs of the operation or the milling processes, and hence there's surplus electricity which can then be put onto the grid, and this is the case in a number of poor African countries today. And lastly, although not of a low carbon characteristic, it does provide a carbon energy solution, as in further downstream from sugar, we can actually refine, as we've seen in Brazil, ethanol. And ethanol, unlike the corn-based ethanol that you are more familiar with in the US, sugar-based ethanol is a much more efficient energy converter. So 1 unit of energy from the sugar produces a surplus unit of energy in terms of consumption, unlike corn, where you actually need to input a lot more energy to get 1 unit of energy out. So then you have a sugar company, which is ultimately actually a renewable energy company. And when you value it, if you look at it differently, you take it from being an agricultural commodity company to being one that has got an oil and gas or a carbon energy component, one that has got a utility component, as in the ability to produce renewable energy, and one that has a traditional agricultural element to it. That's given you sort of an insight to some of the ways that we think about investment. To maybe just take a moment, any sort of questions, Graham, or can I dive right onto the issue of the voting platform as a key component?
Malcolm, while you were talking about Illovo, I just pulled up their website. If you look on their website where they talk about their products, they're not highlighting the ethanol play. Why do you think that is?
Well, the key issue is that in South Africa, where they have their largest alcohol operations, they don't in actual fact produce ethanol. The reason being that it's regulatorily controlled in South Africa, given the fact that we have a very large synthetic fuel producer in South Africa known as SAF. And the alcohol production, because ethanol is ultimately an alcohol, in actual fact is refined further into key inputs into various other downstream products, such as medicines for the alcohol industry and for specific agricultural products that are needed, quite sort of higher refined products further downstream. In the other markets, they are still waiting for regulatory approvals in Malawi and Zambia, but they are quite far down the process of having those approved.
Okay, great, thanks. And if you can flip then to the global engagement.
Great. One of the key issues is that I think, as any responsible investor will say, a key component of responsible investment is information and transparency. So in the spirit of transparency, I'm going to give you a context of the voting platform that Graham has mentioned, but this is something which we're in the process of implementing, which we've pretty much developed in South Africa and are now rolling out across our global business. Essentially, we are about to release a stewardship statement which will more clearly clarify, and it's not available on the website yet, the beta version I have access to, it's not available publicly yet. Essentially, clarify the context of acting as stewards of capital. The key issue being that we obviously act on behalf of asset owners, and in our role as asset owners, we need to essentially assume the role of the stewards of other people's capital. We have to realize that we are exercising the full spectrum of rights that owners have. Those rights are obviously, amongst others, include the voting rights that we have as shareholders on behalf of our various clients. So we have implemented a new stewardship process across our business. We have developed a much more comprehensive proxy voting guideline and governance framework. And that proxy voting guideline has been very much written from a philosophical perspective, which takes into account the fact that we are acting as shareholders and hence that we are exercising shareholder rights. Obviously an important stakeholder, but not the only stakeholder in the investment value chain. In terms of the voting platform, the intention is that we will be voting all our proxies across the world. We have engaged with a proxy voting partner, and essentially we will be requiring all of our investment teams to, and depending on the investment policy, because it will differ for investment process to investment policy, to essentially ensure that they are fully aware of the way that the votes are being cast. The most extensive example of this is in South Africa, and Graham may be able to access it for you, although I'm not entirely sure if we'll be able to find it now, but is in the South African market where we vote well over 1,000 proxies every year in South Africa. And it's much more important in South Africa because we are such a dominant shareholder in this market. In cases where we own up to 20-30% of a company, the exercising of our shareholder rights are fundamentally important. Obviously, along with voting of shareholder rights comes further responsibilities, and that is in order to communicate and engage with the companies within which you're invested or partnering with. So we are developing, and we have developed over the past 2 years, a fairly extensive engagement methodology where we both internally and externally, and when I say externally, using an external service provider as well, further engage with companies around issues. So as not to simply just be a voting approach, but also a voting and engagement approach, where we can in actual fact talk to our companies about the issues that we find that we consider important. And that will be across the spectrum, whether it be around the capital structure, the nature of the board, and then the functionality and operational efficiency of the board, remuneration structures, key strategic issues, and those might come to environmental and social issues as well. Although environmental and social issues are very seldom proxies in markets outside of the US. It's quite unique in the US where you have a proxy season and environmental and social proxies are promoted. So that's pretty much what we're doing in that environment. We see it as having benefits for the kind of three key stakeholders in our organization. Firstly, for the clients, it's an effective exercising of their rights, and more importantly, an important way of preserving and in most cases unlocking value. We think it's important for the companies, because for companies, I think a mature and engaged shareholder is one that actually ultimately has value and provides clear insight, and then actually over time helps both the board and management have a better understanding of shareholder expectation and hence a clearer understanding of shareholder value. At the same time, by engaging over time, we help keep the share prices closer to the efficient price, which makes sure that company capital structures are efficiently structured, both in terms of debt and equity pricing. And then last, in terms of our analysts, our experience has been that by developing an engagement approach, our analysts develop a deeper and more valuable insight of the company due to the fact that they spend more time looking at slightly different information, arguably of a non or extra financial character. And ultimately it improves and gives them a much more holistic understanding of the company, the feedback loop being, and it ultimately has value for the clients and then for the company themselves. So that's been our approach to engagement and voting, and hopefully it's given you an idea of some of the stuff we have been doing in the last couple of years.
Thanks, Malcolm. And I was able to put up the webpage, so it's all there. It's great. I've got two questions. I'm going to ask each of the students to just introduce themselves by name and then ask a short, clear, crisp question.
My name is Rotini Thomas. Short question is, what regions in Africa do you feel have the most promising investment opportunities?
Just to make sure I heard the question properly, which regions in Africa do we think have got the most promising investments? Is that correct?
That's correct, yeah.
Look, Africa, it's quite interesting. We talk about the BRICS, and increasingly Africa is starting to gain traction as an investment destination in its own right. Africa is a continent of 52 countries. One can imagine the diversity of just geography, culture, and political landscape, etc. that exists. When you say most exciting investment opportunities, it very much depends on one, the nature of the investor. So whether we're talking about private equity investments or whether we're talking about very long duration listed equity investments where people can tolerate more illiquid investments, or whether we're talking about traditional retail investments. My colleague, we have a private equity fund, and we have recently done a deal in Zimbabwe, which obviously within the U.S. context may sound slightly controversial, but post-dollarization, economic opportunities are starting to open up there, and we remain optimistic that a political solution will be found in Zimbabwe. We have got investments in Nigeria in the private equity space, in the oil and gas space, and we have a number of other, a number which I can't speak about at the moment, investment opportunities, which are soon to be closed out in the credit space and in the mobile telephony spaces. In the listed equity space, we have about $1 billion invested across the continent. Nigeria is probably one of the most exciting markets at the moment, given both the demographic characteristics of the market as well as the political stability that has been evolving in that country over the past 10 to 15 years. Kenya is another very interesting market. Both of those are probably of a slightly more liquid nature. We do, however, find some interesting investment opportunities in Ghana and as well as in Zambia. But those are very illiquid markets, and they are markets where you need to have a very long duration perspective, notwithstanding the fact that the assets are listed. Just to emphasize that point, the market in Zambia opens up once a week for 3 hours on a Wednesday. So there's no such thing as a daily beating.
Okay, great. Thanks, Mark. Next question?
Hi, Malcolm. My name is Will Waterhans, and we've been asked to put ourselves in the shoes of investors on how to value environmental, social, and governance issues. I was wondering how Investec values that, and whether or not it's an afterthought or if it's of primary importance when you're considering an investment.
That's a great question, in actual fact. So I'm going to give you the direct answer, which is that internal to our business, there are actually a various number of approaches. We actually take a multi-strategy, multi-boutique operation, and in some operations, environmental and social characteristics are of a very unimportant nature. Although, having said that, increasingly people are starting to realize the value of them. However, in the processes that I run, which are the responsible investment processes, they're actually core to what we do. And in valuing it, it's been a journey. I started off 10 years ago with a view that we needed to have very defined metrics, and that using those very defined metrics, we would then be able to compare investment opportunities across our investment universes. And what I've realized and learned over the years is that one has to approach each investment specifically, and one has to find means and mechanisms for integrating your insights at an environmental or social level back into traditional metrics. So we've developed a methodology which basically looks to apply insights to the traditional P&L and balance sheet issues. So to give you an example, if you're looking at an environmental risk, let's take, for example, a potential off-balance sheet yet to be accounted for potential environmental liability. So an operation which has historically had a number of externalities. Those externalities are quite negative for the environment and possibly for a community. The way that I would account for that, given that I have no way of sensibly valuing it, is that I would start to adjust the cost of capital for that organization, pushing the cost of capital up. And because I've got no way of knowing what it's going to mean for the potential income statement at either a revenue or at a cost line, but I can start adjusting the cost of capital higher over time to take into account the fact that I will need a higher return to meet from the company to potentially integrate or take into account the effect of these as yet to be determined liabilities. Now that may appear slightly penal, and for those of you that do finance, you'll obviously understand that the present value of an asset is a function of its future cash flows. Adjust the discount rate upwards, and you're going to be suppressing the value of the company. But that essentially is one way of doing it on an unknown issue. Where you have some way of rationally putting a price to it, whether it be a carbon tax, which you can integrate into the cost or tax line, or if there's an opportunity where you can rationally price, like in the case of Ilovo, what price they're going to be able to sell electricity for in 3 to 5 years' time, you just integrate it into the revenue line or into the cost line as appropriate. So my approach has been one of being pragmatic and actually finding ways of integrating on a company-by-company basis the insights we get at an E and a S level into the actual company itself.
Malcolm, that's great. Thanks so much for staying up late. It's been excellent to have you in live from South Africa. Thanks for your insights. I'll be sharing the links to the web pages. If you have anything else you want me to share with the students, please go ahead. So on behalf of the students, thank you very much for dialing in. Okay guys, let's take
Well, I think
Sure, go ahead Malcolm.
No, I was going to say thank you very much and enjoy the rest of the class. Good night.
So guys, we're going to take like a 10-minute break. There's some drinks at the back there. Grab them. As soon as you're back, we can continue. We're going to dive straight into the case topic. Okay? All right guys, can we start? Let's go. Okay, anyone who I recall has not spoken in the first half has to speak in the second half. Okay? That's the deal. All right? Yeah, let's go. So, step one, you have the case in front of you. Yeah? Guys, here we go. Let's go.
Yes.
Okay, thank you. Other than Kareem, have you got the case in front of you?
Yes.
Anyone do some back checks? What is generation? Are they still, do they still exist?
Yes.
How do you know?
I Googled them.
And?
They have a nice website.
How fresh is your Google search? Because that's not what I know.
Really?
Oh.
I just Googled them. Hold on, I gotta bring it.
Oh, no, well, if it's on the interwebs, it must be right. I'm messing with you. Okay, pretend to look down at the case even if you're not looking at it. Okay? Are you looking at the
I
case?
have it on my computer.
Excellent,
Yes.
good.
Yes.
How do you feel about the case? Let's go, guys, let's go, let's move. 10 minutes, done.
I feel like a lot of
You feel, you know, you analyze. Come on, give me some sharp Fuqua quality language.
I saw that a lot of the things that they were addressing in their specific incident would apply beyond that realm, dealing with the their own personal values and what they need to provide to their consumers.
Okay, just some guidelines to how I might apply the Socratic method of case study learning. You guys done case studies before?
Yes.
Okay, we start with a fact check, then we move to a timeline, then we develop our critical questions, and then we create a position and back into how we got to that position. Okay, using facts from the case. Right, so Josh, you have a clarifying
Hold on,
question?
can I ask a high level question before we dig in?
Does it apply to the case?
Bugging me a little bit.
Oh, you
It's
you've been
related to the
bugged.
case.
Okay, go. 60 seconds.
It's proponents of sustainable investing
Yes.
think that there will be excess returns by
Yes.
investing in companies who believe in ESG, but today it seems like companies that ignore ESG,
Yes.
their problems are socialized to society.
Yes.
So absent government regulation,
Yes.
e.g. a cap and trade or carbon
Yes.
tax, why do they think this is going to change and these companies will still outperform?
First of all, I'll characterize your assertion as partly based on facts, partly based on your interpretation. I don't think all sustainable investors present the argument that it'll generate better returns. I know some people stay a long way away from that. So I would clarify the assertion that way. The issue of externalizing costs, yes, that's exactly what happens, and that's why we have water pollution and issues that people have to pick up. That's why obesity costs the public health system, and that's because too many people eat too much of the wrong food. That would be my 60-second answer, and we can pick it up after. So, I wanted to still bug you through the rest of the class as you think through that, and then let's apply that to how is this case study illustrate how one investment proposition is trying to tackle that. Okay. Thank you. So the case, give me the facts, who's involved, lead us up to the timeline, then we look at critical questions, then we take up a position and back that with the facts of the case. Go, give me facts.
2004, former Goldman Sachs hotshot establishes a company with Al Gore, focusing on merging his love for money and love for the environment or sustainable investing. That's how Generation was born.
Okay, what did they choose not to do?
Find another investment firm.
Yeah.
Louder.
They chose not to buy some Swedish investment firm.
Swiss.
Swiss.
Okay, why did they choose not to?
They wanted to start with a clean slate and start their own ethics value instead of bringing something in.
Okay, but they were very careful to mention there's nothing wrong with the other company. Well, it's fun to me to read that. Okay, go. Give me other facts. Facts that leads us up to this kind of investment committee decision. Go.
They changed the way that the firm was designed, and that they put the sustainability research professionals and the analysts together in one function.
Okay.
They were housed together and put together.
So it's different to what or who?
Different to other assets.
Okay. And even in particular, sustainable investment firms. Yeah? Okay. So very often when I'm dealing with clients and we talk about what is the investment architecture that we're going to deploy, the first thing someone will want to know is wants to know, are we going to do the ESG first, before the financial, or are we going to do the financial before the ESG? And what their heads kind of explode is when you say, oh, actually we're going to integrate it. And that's normally a very long and tough series of conversations as we can debate how exactly to do that. Okay, give me other facts. Go, people.
5% of profits are siphoned off to their nonprofit foundation that basically advocates for the mission from another perspective.
Okay, which is also kind of a smart marketing plan, right? That gets you appearing at conferences, you can put that money into the book, but you can also kind of expand thinking. So there is a Generation Investment Management Foundation. Could you Google that? It's worth it. When you find it, let me know. Did my laptop jockey find my BP valuation?
You asked me about McKinsey.
Oh, sorry, correction. McKinsey, did you find it?
I found a PowerPoint and should I just read one of the slides?
Okay.
I
It's
just
the
interpreted
one that deals with corporate governance.
Yes.
Yeah, read it.
So basically it says they surveyed investors and they said they value governance more in developing countries rather than developed countries.
Yeah.
So that was the main.
Yeah. So the other net takeaway in emerging markets in 2002, they interviewed CEOs as strategic buyers or investors of companies, and the CEOs said we would pay 30% premium for a company that had well-run corporate governance. Put that into your financial model and smoke it. Okay, other facts, go.
They're known for part of doing research and churning out industry white papers and industry roadmaps.
Okay.
It's part of their investment
Okay,
process.
good. What else? Go.
The approach was more like strategy and practice-wise as opposed to a specific action around one. Like it seems recycling and paper was more of a practice and not just the act of actually setting up a program for that.
Okay, so it's strategic, has to be integrated. What else? What other facts?
I think they're running well, they have to make a decision about the investment.
Which investment?
ABB India.
What about it?
So, well, ABB India, they have potential growth because of India have very low electrification rate. But the way they power India is using a lot of coal, they'll be seriously affecting policy and those investments.
Okay, so that is the proximate question facing us. Okay, let's map out some other facts before we get to the timeline and the critical question.
There's a 1-year lock-in period that if a person invests, I think it's a few $1 million that you have to invest, and they have.
So. And let's just do this for the rest of the case. No pronouns. Okay. No they or it or what have you. Let's use name.
Generation. If a person invests in Generation, they have to. The person who is investing has a lock-in period for at least a year.
Okay. And why do you think that is?
So there are no speculators. Whoever is investing, they're not speculators.
And also, anyone done a startup business? Who is in startups? Andrew, weren't you in startups?
Yeah.
Good. Welcome back. Nice to see you. Thank you very much. So what as a startup, do you want clients to come and go or clients in for a year?
Definitely want long-term stakeholders involved.
Yeah, it's just an asset management firm. It's a glorified startup. They could be selling widgets. They're selling the ability to make you more money. So they want clients dialed in for at least a year. Not a lot, let alone, that's just at a kind of asset gathering level, right? Kind of gathering the initial assets. But also at the portfolio management level. If you've just taken positions, you go through such pain, you write white papers to develop positions, and now the dude, is leaving 31 days later. So there's just some basic investment management mechanics behind that. Okay, go, give me other facts, go.
They had a three-pronged value proposition.
Go.
First and foremost is they wanted to have higher returns than the industry. They wanted to be sustainable themselves. And three, they wanted to generate conversation about what it means to be successful in business.
Okay, and joining the dots to the ultimate question here is, which one of those three propositions comes out in the case problem?
Unfortunately, I didn't get a chance to finish it, but I think it's interesting that they say first they want to outperform the market.
Okay.
So that's the first
So
one.
performance question, performance problem. Okay, give me other facts. Where they're based? Where's this happening? Come with this in for me. Go. London. Okay, which is what? Small or big asset management location? Okay, good. Where are they looking to deploy the money? In the next suburb, the next city, the next country, where? They got a global mandate, okay? Which means they got one heck of a back office because they need to execute on that, right? Bought and sold anything in Zambia lately? When did Malcolm say the market's open? Wednesday afternoon. Isn't that fantastic? That's real. That's investing in frontier and emerging markets. That's why the term emerging markets was coined when they're trying to, in the 80s, deploy money. That's fun. That's what makes what I do a lot of fun. How do you do it? Find the company, great. Now I found the owners of the company. Now I found out how to buy securities in the ownership of that company.
E-Trade doesn't trade it, you can do that.
Yeah, I looked on Google. Okay, what else about the situation? Small team, large team. How does the team work? Josh, you want to say something?
I was going to say they take an active role in talking with their invested companies or potential companies that they're looking to invest in and try and find out if they really walk the walk or if they just...
Right. So now, your two classic types of investing, broadly speaking, passive investing, active investing. Passive investing, find me an index, what does it imply? There's already people there that you can build an index from. Yeah? So we have active investors, akin almost to private equity. Even venture capital, depending on how small they make some valuation. Yeah? This is why I really like the case, because we can talk in many different directions about how asset management works. So they go and they meet and they talk to these companies. They kick some ties. Classic, active, fundamental, bottom-up investing. Okay, give me some other facts. What else is going on?
They measure the companies based on qualitative and quantitative metrics that they created.
Okay, talk to me about the NQ and the BQ.
So the VQ, they talk about like barriers to entry, future growth. It's more like the business side of the company, and then MQ is more towards the management, the quality of the governance.
Sound reasonable as MBAs? Any MBAs run out screaming, holding their heads when they read that? Does that sound reasonable to you as an MBA? Are you an MBA?
Yeah.
Okay. It's not like being an investment banker. That was just a year. Okay, what else? How do they? Investment management is 3 steps. Go. Okay, how do they do it? Piece my friend in the box.
They target all their rich friends.
Wait, I'm gonna do the stereo. Go. Yes. You're back.
Well, they spend a lot of time researching and then they present their.
Who's that?
The analysts that they've hired.
Where?
In London.
At Generation. We don't use pronouns in this case study.
The analysts at Generation spend a lot of time researching and present their company in front of the team.
Do you know the names of any analysts from the case?
Yes.
Joanne, name an analyst. Maybe look on the first row of the first sentence.
I didn't get the case, it didn't go through the email, so.
Okay, could you sit next to someone who does and adopt a team approach to the problem? Thank you. Joanne. Anyone?
David Lowe.
Can we teach team building exercises in the first week of these programs?
We actually do.
You do? What's worse than not having a team? Is being taught.
It's a month long, so by the end you're convinced it doesn't work.
It doesn't work. No trust falls Graham from accounting. Okay. Alright, so we got an investment decision. Okay, what else do I need to know about the background? Maybe you haven't even talking through the exhibits. Come on, there's some beautiful little exhibits there. Exhibit 1, 2, 3, 4, 5. Talk to me about exhibit 5. Anyone, go. Look at the page, read some words, and express yourself in an intended MBA fashion to impress the lecturer. Go.
First step is to come up with a lot of different ideas that match the firm's generation of...
Idea generation. Have you heard that phrase before? Anyone?
Yes.
Yes.
Do go on.
It's when you generate multiple thoughts and ideas. Brainstorming. Cognitive dissonance. What other things?
Thank you. Good. Deepak, does that describe idea generation? You happy with that? Yes. Okay. And step 2?
Investment decisions.
Make an investment decision based on the metrics that have been defined, such as business quality, management quality, B2 and Q.
Okay. And the third and final step?
Go ahead and make an investment and manage the risk of the portfolio that you build. You, in this case, is generation.
Excellent. So all falls under step 2, manage money and report on it, make more money. So we've got a 3-step process. Sound reasonable? Thoughts, ideas? Go.
I think what was interesting in the case on the...
Must be louder, I'm sorry.
I said what was interesting about this process of idea generation was how some investments will make sense to them and not to others, because they are going to take risks.
Others, what others?
Other investors.
Okay.
Because they're willing to bet on long-term ESG positive externalities that the other people are not going to take into account.
Okay.
That
Define long-term for me. Where does it stand in the case? Give me another.
So in the case, the average holding period for their investment was 2 years, I think.
Someone help him?
2 years,
There's
yes.
30 eyes in here.
It was 2 years. So
2 years.
they target a generation targets investments that has a potential 20% upside, and if they reach the upside, they get out.
Okay.
The generation gets out.
So it's time-driven or event-driven? Time-driven, it's how long?
2 years.
Event-driven, it's?
20% upside.
Okay. Got it? It's what's called your investment discipline or your sell discipline, right? Really easy to make investment decisions. Your favorite stock. You will Google at the IPO. It's just tracked up and up and up. Beautiful things happen. When it pops down or you break through what you thought your returns expectations were, you can't let go of it because it's kind of your favorite stock and it's always been good to you, and you forget to sell it and then you get smacked on the downside. Yeah? So your sell discipline, you got a very clear framework how we're going to do this. We'll pick up the holding periods issue in the case. We faced in this case with an investment decision. Yes? Agree, disagree? Yes? So in the exhibit that maps out the staffing of the shop, can someone just run me through the staffing of the shop? I think it's exhibit 4, exhibit 3. Go, anyone. Look at the page, read the words, give it back to the seminar. Back to the pink shirts. Were you checking the scores just then, or are you looking at the page?
No, I'm looking at the page.
Alright, go.
Exhibit 4.
Do it.
So you have Al Gore as the chairman and David Blood as the managing partner. And then
Do you think
there's
they use those two in the asset gathering phase of their program? Yeah, go on.
Sure.
What else about this shop? How's it start? What is it looking like?
It has several divisions. There's a control and finance group, an investment management group, or client management group, a group that deals with within the investment managing group, they also have subdivisions as well, between financials, industrials, consumer companies.
Okay, good. So, control and finance is kind of your middle office, client management, front office. Industrials. So David Lowish which someone explained to me was the key analyst and person here. What's in brackets? What does that number mean?
Experience.
You're gonna shout it out.
Years of
Years of investment experience.
Thank you, good, okay. So, we've got someone called David Lowish, who the first line introduces us, sitting in London. You notice it doesn't say on a sunny day, just back from his morning surf, kayak down the Thames. There's a reason why people manage money in London, because there's nothing else to do. So, young David is faced with this problem. Now, who does young David have to... So why doesn't young David just say, hey, I found this new company, and let's go?
Because that's not how generation works.
Okay, explain.
They have a board of directors that monitors, or in these investment decisions, one member of the board of directors sits in, and it's a group process to make the decision investing in the company.
Okay. Okay.
Plus, there are some other issues with this specific investment that the case discussed.
All right. So if they're facts, let's throw them out there. Let's go to facts, and then I want to get to timeline. So we're giving you other facts about the investment opportunity.
Okay, so it's an Indian power generating company called ABB India, and the problem is that it's a huge presents a huge opportunity investing in this company. India has a growing population, and they under electrified, but they would use coal reserve. The company ABB would use coal to generate this power, and that's conflicts with the interest of generation or investment philosophy.
Does it? Why? Well, where do you see that? You
They
mean
are
Exhibit 1, perhaps?
Exhibit 1 because they have climate change listed as one of their concerns.
Exhibit 2. Exhibit 3. What is the investment philosophy? Go on. Anyone, jump in. This is how we move quickly,
The
people.
crux of it is that some of their key sort of criteria for investment are
Yes.
climate change issues and
Yes.
poverty alleviation.
Yes.
And, rural electrification
Yes.
on a large scale addresses poverty, but
Okay.
at the cost of climate change concerns.
Okay.
Weighing these two.
Okay. Does it talk at all with where they buy the coal from and how that creates jobs in other countries?
Get back.
I like that answer. Go ahead. Good analyst. That's an interesting angle. India gets most of its coal from which two great rugby-playing nations?
They have
They imported coal.
Don't they have their own coal?
They do. Or whether they import coal. What's even better rugby-playing nation? I was close to immediate B, by the way. I'm feeling generous today. All right. Give me other facts. What about the investment opportunity? If you're making an investment, well, it's going to map to these guidelines that we have, the timeline horizon, the holding period, the financials. How's it looking? Has he checked it out, or did he just have this idea and just send an email, hey guys, it's a go? Talk to me, what is the analyst done?
With regards to the timeline, he said that he wanted a little more time because he still didn't get a feel for exactly how the government officials really want to approach this and how long it might take in terms of regulation.
So you've got revenue issues,
Yes.
yeah? Potential revenue issues based on a regulatory constraint, okay? Has he pitched the idea yet to his investment committee?
Yeah.
How do you know? What happened?
Case talked about it. And it didn't. So there's going to be a follow-up meeting because they couldn't make a decision. The generation couldn't make a decision.
Okay, so he has pitched it to his investment committee, which we described in the exhibits, yeah? And the investment committee said what? This is where you skim the page to find the investment committee or reject. Now it's about it.
They are split right now.
Say again?
The investment for the group is split.
The group is split. Okay,
There isn't
go on.
a
This is
consensus
interesting.
yet. The issue is on one side, the team believes that this will alleviate poverty through pursuing greater economic development because of increased power generation at ABB's clients. But on the other hand, the other part of the team believes that this is also encouraging carbon-intensive activity, which doesn't necessarily fit with what generation wants.
But what about the argument that they're just investing now, and they can get out of the investment soon, and then the carbon problem goes away?
Their name is different.
Indirect.
Okay, also, and what if you're providing capital to a firm that makes little pieces of carbon footprint or big pieces of carbon footprint for tomorrow or for a long time? Go on.
40 years. Carbon stays in the air.
Right, okay, that's the carbon, but the thing. Exactly, so so this is why the investment committee is having such a problem, right? So it would be okay if it was like, let's buy into Tata, they're rolling out the Tata Nano, it's safer than riding on the motorbikes, but they're cars, but they still got a very small impact, and they could in 3 years' time come out with a hybrid version. Cool, no worries, do it. But here they're investing into power generation. And once the infrastructure is up, no banker or investor wants to see that thing come down for as long as possible. How many nuclear power stations in the US have had their working life extended? Bonus question.
103.
Yeah. Oh, and by the way, if Yucca Mountain is closed, where's that nuclear waste being stored?
It's all stored on
On
site.
site.
How do you feel about that as residents of the country?
As long as I'm far away from the power plant.
Want to know exactly where in Cape Town I live in case need a heads up. Let's also think about, there's another piece where they talk about the themes, all right? We picked up on, they've got this thematic approach to investing. They write these white papers, right? They try and get the high level. Why? Because they're not just bolting on ESG. They're trying to develop this kind of complex thematic around where should we invest, what's happening. So with their healthcare team, yes, they've probably looked at obesity as a major trend and how you're going to invest around that. If you look at the top of page 18, where they cover, it's all part of Exhibit 5 as they map out the investment process. They've got the 4 stages there. What are those 4 stages mapped to? And they talk about it in the actual text of the case. But what is that exhibit explaining?
Maturity of different.
Go ahead.
The maturity of the different industries.
Exactly. So their investment proposition and the investment process helps map that and unpack that. They want to understand of this, they go away and do this big thematic white paper. Great. How are we going to bucket things and when are we going to go in? What's going to be some of the disciplines? Well, if they take the 4 components, pre-dawn, emerging, peak, and fade, and here they've mapped it against CO2, they've got to decide as an investment committee, as an investment team, where is this particular play that we're developing as a thematic, where is it in the scope of the issue? Yeah? So they don't give us the helpful chart for that exactly. They give it for the CO2, but they don't map exactly the access to power argument, which is the second part of that conundrum. Is there anyone on the advisory committee who can help? I didn't really see much help in that. CapEx numbers didn't offer me anything. I'm just skimming through any of the back material to see what we have. All right, do we have a time constraint on this investment decision? What does the case tell us? How quickly does young David have to move?
He's meeting with them tomorrow.
All right, like all good HBS cases, yeah? Staring out the window. And the decision faced with him is, am I great or great? So he has to propose a way. Okay, let's get to the approximate question. What is the decision point? Let's clarify what his options are. Go. Someone give it to me. What is exactly the decision point that they want us to consider in this case study?
Is the economic development sustainability argument, is that worth overriding the environmental sustainability?
I agree that's an overarching theme to this, but make it much more granular.
Invest in this company or not?
Okay, where?
Immediately.
Okay, is the option. From what I read, I don't see any reason why, if the investment committee decides, we can't trigger that afternoon. Okay? Unless someone else read, there's some constraint about when the horizon to execute on that. So 2 questions I'd like you to consider, then we've got to cut to a phone call very appropriately with TrueCost, the guys who do a lot of the carbon intensity around portfolios. We're working with a lot with the Carbon Disclosure Project data and then the green rankings. So before we go to that call, I want you to be clear on your answers to two questions. One, would you invest in the fund itself? Okay. And two, should the fund invest in an investment opportunity? There's actually two investment decisions I want you to consider. Okay? So Katie, can we make that last call? All right. Is everyone clear about what the ask is? Okay? Is there any other facts you think we skimmed over or missed that you think was still important to deciding on this case? I think we've moved way too quickly. I want to now go to the investment value chain. Is there anything from the investment value chain you think that we should have pulled through on this particular case? Because I have a question, because I haven't seen the meeting notes or the data that they've used to arrive at some of these decisions. Some of these charts are a little weak, in other words, a little general.
I think the measuring schematics that they use would be helpful too. They scale things on a range of 1 to 5, and they don't really define where each group category fits in.
Are you suggesting that net investment decision might be qualitative?
That's how they're making it. If it's above a 3, then they're not going to invest. But if they're rated a 3 on both sides, then they may invest or not.
Okay. Carrie, are you there?
Produced by Duke University. Online at duke.edu.